Hi, this is Brian Linchey with your weekly market update. It was a busy week with key updates from the Fed, inflation, housing, and the broader economy. As expected, the Federal Reserve held its benchmark rate steady at 3.5% to 3.75%, marking the third straight meeting without a change after last year's cuts. While that wasn't a surprise, the vote showed growing division within the Fed, with 4 officials dissenting, the most in decades. One favored a cut, while others pushed for patience as inflation remains above target. Fed Chair Jerome Powell also said he plans to stay on the Board of Governors after his term as chair ends, pointing to the importance of keeping policy data-driven and independent. On inflation, prices moved higher in March. Headline PCE rose 0.7%, mainly driven by higher gas prices tied to Middle East tensions, pushing the annual rate to 3.5%. Core PCE, the Fed's preferred measure that excludes food and energy, rose a more moderate 0.3%, with the annual rate at 3.2%. Inflation is still running above target, which helps explain why the Fed is staying cautious on any rate cuts. In housing, home prices have now risen for 7 straight months, according to Case-Shiller. And even steady gains add up. For example, a $500,000 home appreciating 3% adds about $15,000 in value over a year, highlighting the long-term benefit of ownership. New construction was mixed. Housing starts rose nearly 11% in March, but building permits fell by a similar amount, suggesting builders are still cautious. Finally, the economy grew at a 2% annual pace in Q1, up from 0.5% in Q4, while initial jobless claims remain low, partly reflecting the growing role of gig work. If you have questions about buying or refinancing, I'm here to help anytime.